Hello everybody and welcome to the Tortoise channel. Happy to have you join us. If you are new here, welcome, and if you are not, thank you so much for the ongoing support. You guys have been amazing. Thanks a lot for the messages that you guys have been sending, and also to the comments that I see to the video. So that really helps the channel to grow, and that's what we're here for, right? We want to grow the channel while providing a ton of value for you guys. Speaking of value, today's video is going to be about Microsoft's recent earnings report, which, I mean, for those of you guys who don't know, Microsoft reported earnings 2 days ago, I think, and the stock plummeted after earnings, some 12%, if I'm not mistaken. I'm recording this video, so it's almost 2:30 p.m. here in London, which means that the US markets are almost open. So it's going to be nice to see if the sell-off is going to continue in leading up to the weekend, okay? But we will see. However, I want to discuss exactly the most important aspects of that report. As always, I put everything in a Word document. It's easier for you guys to understand the main takeaways, right? But before I do that, let's discuss something that really perfectly ties into today's video, and that is the problem of emotions and why you guys must at all costs control them if you really want to become the best investors you can be, okay? Pallavi, who has been putting out great content, also wrote this content right here for LinkedIn. And it starts, this is to all investors. So Pallavi, I mean, thank you so much for the great content that you've been creating. This really helps us grow. And she says, and very well, which resonates perfectly well with our brand. To all investors, there will be those rare cycles where your thesis finally begins to materialize. You have identified a business with high returns on invested capital and a management team with significant skin in the game. The margin of safety was wide when you entered. You can see the clear path to doubling your capital over the next 4 to 5 years. Then, boom, macro volatility hits. The market initiates a 10% drawdown. The average investor, the one currently tracking at a 3.6% annualized return. I mean, to give you some context, this has been the average annualized return for the average investor from 2001 all the way through 2021, according to a research that was put out by JP Morgan. Just look it up. It's disgusting, if you ask me. I mean, why would you get this I mean, this is horrible. I mean, for context, in fact, for comparison, the S&P 500 over the same time frame achieved 9.3% annualized, a 9.3% annualized return, which is greatly better than this one. And these guys completely clueless. They try to beat the market, but then they buy high. When they should be selling, they sell low when they should be buying. Rinse and repeat. Okay. So they start to liquidate out of pure emotional stress. Your 80% rational framework is suddenly under siege by short-term price action. It's non-negotiable that you maintain your temperament. Volatility is not a risk. Unlike what Skool teaches us, volatility is not risk, right? This is so important. And in fact, Howard Marks, arguably one of the best investors of all time. In fact, you just have to look at his track record. He says this himself: volatility is not risk. The risk is the permanent loss of capital, which is something that we try to avoid at all costs. Okay, so more than thinking about the upside potential of any particular investment, we always think about the potential downside, and that's it. So it's the inventory cost of achieving 15-30% annualized returns. If the meaning of the business has not changed, your position shouldn't either. Persist, stick to the framework, rinse and repeat. And you know, this morning, I had back-to-back calls with some of our clients, and there is this common theme, and this is why this is so important for you guys, and I share this in our free WhatsApp group. And it really feeds it to what we've been discussing so far. A few sessions this morning with some of you reminded me just how important patience really is in investing. My goal is not only for you to become capable of finding great investments on your own and feel completely comfortable managing your own money, but also to become emotionally resilient, because stomach is by far the most important organ in the stock market, not the brain, but the stomach. You must invest in your brain, not your emotions. And the best way to achieve this, in my opinion, are understanding what you are investing in, right? If you cannot explain how a company makes money, you shouldn't invest in it. And many people that come to me panicking, should I buy? Should I sell? The reason is they don't understand what they own. And when you don't understand what you own, of course you will panic. And this is not how you can set yourself up for financial freedom. So in second point, demand a margin of safety. Never buy anything without one. If you estimate the company's intrinsic value at $100 per share, only buy it with a 50% margin of safety. In other words, at $50 a share. Great thing happens when you buy $1 for 50 cents. I will leave you with this great quote by Charlie Munger. As you can see right here, Charlie Munger says investors who cannot handle market volatility deserve the mediocre result they will get. As simple as that. Cool. With that said, let's hop right into our video today, the core of our video, and that is Microsoft's earnings and the subsequent market tumble. So let's see exactly what happened. Look, in my opinion, it was another blowout quarter. So you actually, this might surprise you. You may think, okay, if you think it was so good, why has the stock plummeted 12%? The reason is because of the expectations that were built into the stock price going into earnings. Let me explain what that means. So let me minimize this. Microsoft delivered a clean earnings beat, but the stock still fell 12%, dragging the entire complex with it. This wasn't about weak results, it was about expectations, cloud growth anxiety, and yes, AI capex fears. But the headline strong on paper. Look at this. They beat on revenue, they beat on earnings per share. The Microsoft cloud revenue jumped 26% year over year from 51.5 billion to 51.5 billion. This was the first time that it topped $50 billion. Market cap recently touched 4 trillion before the sell-off. This is absolutely amazing, guys. These companies really defy logic. You would think that because they are already big companies, I mean, right? And that is to put things lightly. $4 trillion company, and these companies are still managing to grow at double digits. This is staggering. Okay, so why did the stock drop? Two concerns dominated investor reactions. Number one, cloud growth is slowing slightly. All right, this was one of the major themes. Azure and intelligent cloud beat expectations, however, growth decelerated modestly. And of course, in a market priced for near perfection, good wasn't good enough. With peers also reporting strong results, the bar had been moved higher. Expectations had built up ahead of these earnings reports. And sure enough, because investors that were buying it had no margin of safety, now they are hoping and praying that the stock eventually comes back up. That's what it is. This was a rate of change problem, not a level problem. In my opinion, what's really staggering is the amount of capex that they are committing over the next few years, which is, mind-boggling. Capex surged to almost 38 billion, up from 22.6 billion last year. Massive investment in data centers and AI infrastructure. So investors are again asking, when am I going to see good returns on all of that invested capital? That is the question, right? And when will that translate into incremental margins? Management was clear demand is there, but capacity constraints are temporarily capping revenue. The AI signal beneath the noise. Remaining performance obligations, RPO about 625 billion, 45% linked to OpenAI related commitments. OpenAI, which continues to bleed money like there's no tomorrow, right? They are a money losing machine at the moment. Look, with so much competition in the AI space these days, I don't even know if these guys will ever turn a profit. in all fairness. And this is part of the reason why investors like Warren Buffett and many other great investors avoid technology at all costs. Exactly because we don't know when these things will be replaced. Okay, I mean, in myself included, I just avoid companies that are pure software plays, exactly because they are subject to a lot of disruption. And sure enough, that's why we saw all these software companies that are perceived that are perceived to be at risk of AI replacement. This is why we saw them selling off over the last several months. Okay, not to say that AI will affect all of them equally. In fact, in the video that I put out just a few days ago, in fact, I think it was one of the last videos, I tried to break it up. Right, so I try to break everything down, and it comes down to understanding which spaces will be more affected than others. But watch that video if you are interested in this space. And so, as Satya Nadella put it, we are only at the beginning phases of AI diffusion, which is good. So what is the Leica Tortoise takeaway? This was not a fundamental breakdown. Core business are growing. Cloud is still expanding attractively and at scale. AI demand outstrips supply. Cash flows remain enormous. So the sell-off reflects valuation sensitivity and short-term fear, not a deterioration in Microsoft's long-term compounding engine. This is what happens when a generational compounder is priced for perfection. There is nothing wrong with Microsoft, unlike many of you might think. What's wrong is that the investors were pricing the company. They were pricing the company near perfection. All right, and then this thing can happen. Now, about the all the AI capex, I will show you exactly why I don't really like this. And this is what I mean. I demand the margin of safety for all our investments. But what happens with capex, guys, is that it may take you it may even take years for any of these investments to actually translate into profits. And sure enough, if you go here to their returns on invested capital, right, which shows you the efficiency of the company when it comes to deploying capital and getting returns, you can see that all their look what happened to their ROIs, right? The return on invested capital. It's been coming down. This, by the way, is on a quarterly basis. Okay, this is quarterly. I'm not sure this already reflects the earnings report that was put out because it takes a while for the data to update, right? So it's not real time data, but you can see that ROIS has been coming down over the last several quarters, and this is one of the problems. They are investing a ton of money in AI, and we don't know when it will, how long we will have to wait for these returns on capital to actually start showing up. But look, it's what it is, okay? And there is no doubt. So if I show you here capex, the capex of Microsoft is also. I mean, look at this. This is absolutely insane. Look at the jump since 2021. Look at that. This is quarterly. Absolutely scary. All right. And this is what's been spooking some. And surely, if you are an investor in Microsoft, these are questions that you should ask. Man, is this really? How long will it take them? Is this justified? What are they saying? Make sure that you listen to the last conference calls to understand the business that you are invested in, so you don't panic when crashes like this happen. Okay. Speaking of which, the market is already opened. And I can see that the Microsoft is up already half percentage point at the opening. Yeah, I mean, let's see how things unfold. But this is what I wanted to say, guys. And sure enough, we saw a big sell-off across the board. We saw Microsoft down, we saw Oracle down. But what I really like is that if I go to the balance sheet, right, you can see the long-term debt is going down. And what you can see as well is that a lot of those capex investments, let's go here to the cash flow statement, you can see that CapEx currently sits at about 83 billion, right, on a trailing 12-month basis. But you can see how much cash this business generates from operations. And this is what I love about a company like Microsoft, is that they can afford to experiment, right? They can afford to experiment because they have a lot of because the operations of the business generate a ton of cash. All right, so they don't have to borrow money, they don't have to take on debt to actually invest a lot in this experiment, which can work or not. Which can it may work, but it may not work. And so even if AI fails, what I'm trying to arrive at is that even if AI fails, Microsoft will continue to make a ton of money. And that's why I like when a company has multiple exits. And Microsoft is diversified in that sense, which is something that I really like. Whereas if you compare Microsoft to a company like Oracle, you can see the big difference, right? So, for example, look at Oracle. Look at the operating cash flow, right? That Oracle generates, which is about 22 billion. And now look at CapEx expenditures absolutely exploding since 2024. Look at this. So where did they get the money to fuel all these investments? If I go here to the balance sheet and if I go here to the long-term debt, you can see that the long-term debt is going up sharply, okay? And I don't like really leveraged balance sheets, all right? Cool, guys. So I hope you found the video insightful. If you did, please smash the like button, share it with people in your own community that you think might benefit. And if you haven't yet, consider joining us in our WhatsApp group. And I will see you on the other side. But please leave a comment as well. And I hope you are gaining lots of value from these videos because that's the purpose, right? Cheers, guys. Have a great day ahead.